So, you want to be a real estate investor, but where do you start? How do you know what information and sources to trust? That's where I come in. I'm Jonny Cattani, and this is the Investor Relations Real Estate Podcast. Hey guys, real quick, before we start, go to investwithcattani.com and download my free ebook, Is Commercial Real Estate Recession Proof? Now to today's show.
What's up, guys? Happy Friday. Welcome to another episode of Friday Follow-Up here on the Investor Relations Real Estate Podcast. I am your host, Jonny Cattani, and we've done it. We've made it through another week. Feels like these weeks are flying by. I don't know if that's just me. Feels like this year has been flying by. Everything's happening so fast, and yet some things feel so slow. It's amazing how the universe works. But welcome. Grateful that you are here. Hopefully you listened to last week's episode where I made a prediction, because we're going to follow up on that. Because almost as soon as I submitted it and had realized it had been produced, I realized I put like no data behind my economic prediction, which there is a little bit of logic to that. The logic to that was that if you follow me on Instagram, I have been posting reels every day. And last week it was all about economic data. And I didn't really want to just repeat all the economic data. But guess what? That's exactly what I'm going to do today. All the economic data that went into my prediction. If you haven't listened, I would say listen to this first and then go back and listen to last week's Friday follow-up, where I gave my prediction. But huge news, things are still looking great. Honestly, I've said this before, please don't get all your news from mainstream media, all right? If you just read that, then the whole world is coming to an end, and that's not the case. Obviously, interest rates are going up. Some things are changing, right? Stock market's down. We're definitely in a recession. And to not get too ahead of myself, I do think we haven't quite found the bottom, especially with some of these alternative assets, aka things like crypto and that world. Real estate does tend to lag behind as well. So I think you'll see things, and you already are seeing things slowing down. Home prices are coming down. Days on market is going up, right? How long listings are staying listed. So the median home prices come down, right? Interest rates are going up. It's going to naturally happen. But there is some big news. This data is from Marks and Millichap. So since the peak, what we now know is the peak, which was January of this year, essentially Q1 this year, the S&P 500, which is the benchmark index that you use to track the stock market, compare with your portfolio, how's it doing against the S&P. The irony there is that when people ask how the market's doing, they're asking typically about the Dow, which is a different index. So that's a fascinating nuance there. Little FYI, if you're new to the stock market or just learning about it, if they're asking how the market's doing, it's typically going to be the Dow. That is shifting. More people are asking about the S&P. However, when you're using a benchmark to compare your portfolio, whether it be your stock portfolio, real estate, crypto, whatever it is, the benchmark is the S&P. So the S&P 500 is down roughly about 24%, 25% since the peak in January. Commercial real estate as a whole, meaning all asset classes, so that's apartments, self-storage, industrial, retail, office, there's more in there, medical, senior living, all of that as a whole is up 10% since January. My two favorites, apartments and self-storage, as well as you guys know that I've recently gotten big on Airbnbs. Apartments up 10.3%, self-storage, no surprise here, up 15.5%. That asset class just stands the test of time no matter what's happening in the economy. I absolutely love it. Is crushing it, and Airbnbs are up like 40%. It's silly right now. It's just an incredible asset class. So some more things to go over. This is all going to be comparing the stock market right now. S&P 500 over the last quarter over quarter over the last 20 years has seen basically a volatility index of 6.6%. So on average, up 6, down 6% over the quarter over quarter over the last 20 years. Commercial real estate commercial real estate down that same index 20 years, quarter over quarter, 1.8%. So what that means, commercial real estate is far less volatile, which makes it more stable, more predictable, which when you're investing, predictability is huge, especially when you're averaging over a long term, right? I've talked about this. It's important to have a long-term mindset when you're looking at growing your assets, at growing your wealth. So when something has a volatility of one index of 1.8 compared to 6.6, makes it far more stable, more predictable, and, gives us a much better, idea of what's going to happen, far more controllable, right? I don't mean control in the sense of liquidity. It's not as liquid as the stock market, but more control in terms of on a risk adjusted basis, meaning when I take all risks into account and I've adjusted everything for that risk, it's a far more stable and controllable investment. Next one, compound annual growth rate. So as we know, real estate is compounding, returns are compounding, right? You invest 25,000 in 5 years, that will be let's say you invested into a conservative deal, 5-year hold, 2x between cash flow and your exit. That's going to give you 50,000 in 5 years. You then put that into the same thing. You're now making a return. Let's say we'll go conservative. We'll say a 7% annual return. You're now making 7% on 50,000. That then gets 2x. You understand the trend here. Next is 7% on 100,000. That gets 2x. Now you're getting, so you understand what I'm saying here, right? You understand compounding growth rate. Stock market is actually the same when you take into account dividends. It doesn't necessarily work the same because there's not an exit event that pays out a lump sum. It's just the growth of the business or the company or the fund or the index, whatever it is you're investing in, right? So compound annual growth rate, S&P 500 over the last 22 years, this is since 2000, 5.3%, very solid, right? Very, very solid over 22 years. Commercial real estate, however, 7.8%, huge. Talking 2.5% more on a compounding basis. If you got a 2.5% return compounding over 22 years, that's a lot of money, right? As that continues to grow. So to put that in perspective, if you invested in the S&P 500, if you invested $1 million 22 years ago between gains and dividends, you would have $3.2 million. Not terrible. If you invested $1 million in commercial real estate with gains and cash flow, $5.3 million. So that should put into perspective right there the power of real estate and compounding, and going back to that 1.8% quarter over quarter, right? More predictable, more stable. What does that stability lead to? Well, that leads to a higher return. Not a huge shock there. That shouldn't really be big news for anyone. We'll compare this. It's not even fair to compare it to crypto, and I don't mean that in a derogatory sense. Crypto's just gotten crushed this year. I'm an investor in crypto, and my account's way down, but that's okay. I know it'll come back. Not putting a ton more into it. I put a certain amount into it and have just been buying little bits as I'm almost out of cash in that portfolio, but I saved some cash for if it took a huge dive, which it did. So I've been able to dollar cost average, which is nice. So we'll compare it. Bitcoin down 58% year to date, so since January, and Ethereum down 63%. So getting absolutely hammered. those of you in the space, I'm sorry. Hopefully you didn't, you know, bet the farm there. If you did, I am under the belief that it will come back and come back even stronger. So anyway, thanks so much for listening. Go back and listen to last week's if you have not. That will give you the foundation for my prediction for what's going to happen. There's only going to be one more rate hike this year, is what it's looking like, which is coming next month, which means we now have a far better idea of what interest rates are going to be like, which means, yes, things are cooling down and will cool off a little bit more in terms of home prices, more specifically in commercial real estate asset prices, as well as I do believe that rent growth will stabilize as well. But I don't think things are going to be as terrible next year as some may have alluded to, as well as me may have alluded to last week. I think it's just going to be a slow process, and that's just how it's going to be. And we need to prepare for that by investing in inflation resistant assets, aka real estate. So anyways, thanks so much for listening, guys. Have a great weekend. Be safe out there, and I will talk to you next week. See ya. Hey guys, thank you so much for watching today's episode. I hope you really enjoyed it. Listen, I know it's cliche and you hear it all the time, but please don't forget to like and subscribe to the channel so you know when the next video is coming out. Even though this is technically a daily podcast, you know it's coming out the next day. We have a ton of content coming your way. So please like and subscribe. It helps a ton. Leave comments. Would love to know what you guys think. And we will see you on the next one. Thanks so much.